Welcome to the daily update, where I'll go over the action in the market for Monday, January 13th, and we'll see how things look for Tuesday, January 14th. Yeah, we had a little bit of an update. If you look at it on a closing basis, it's like, not much really changed. But intraday, we did see an improvement, and we opened it at or near the low, and then spent the rest of the day, at least after the open got dealt with, coming back up and seeing some buying coming into the market. Now, what's interesting is our smart money indicators, the three that I'll show you here, they've actually turned positive, but we're not seeing really any confirmation as far as our other indicators that we're switching back positive. So was Monday a one-day wonder as far as our smart money indicators? Now, we did see an improvement on Friday. We had a down day on Friday, and one of our smart money indicators showed some improvement. And we did claw our way back in Monday's session, and those indicators are improving as well. But personally, I wait for more confirmation because we still see a lot of negative going on right now. It really hasn't changed the overall climate. And it has to do with interest rates. And even in Monday's session, interest rates continue to go up. Okay, so right at the open, we did have a gap lower. The futures were negative, and Japan was closed, but we're keeping an eye on the 10-year yield there because that's what triggered things that happened last summer. And we had a big downward movement. Well, we'll see what's going on there. But we did have this negative open as things flowed through. Now, a lot of this goes back to Friday with the much stronger than expected employment situation report. And that has really increased a lot of inflation fears, which have already been increasing anyway. And the Fed has come out and said, we're not going to cut rates anymore, and we're going to up our inflation outlook. So we opened below 5,800 and S1 at 57.93, and then we chopped above and below S1. It looked like, okay, nobody's really going to come in and try to drive the market higher or lower. That took care of the open, and then the smart money came in and we chopped, but we moved higher. And by the time we closed, we were slightly positive on the day. We were up 0.16% on above average volume. So that couldn't be healthy under the surface buying. That's why I watch an intraday chart. I don't day trade. I don't, really focus on what the interplay that much, but I try to get a picture of what's happening intraday, and it looked more positive. So we are still negative in the short and intermediate term. We're positive in the long term. Interest rates are a problem. They continue to go up. The dollar keeps going up. And of course, the real news right now is what's going on in Southern California. And let's hope that gets under control and improves here pretty quick. Okay, so some comments. Mega caps underperformed. They didn't have a good day. Value had a pretty good day and it outperformed growth, but it really hasn't changed our growth to value ratios all that much. We're still holding with the 100 period moving average with the S&P. The FANG index is still above its 50-day moving average, the simple moving average, and we're still holding above the small cap 200-day moving average. So, and I'll show you charts of all of these. We did see late day buying. That was a little bit later on, and this stuck a little bit better than it did in Friday's session. They tried to run the market up, but then it gave a lot of that back, and we closed near the lows. But in Monday's session, we did see that improvement as we were approaching the close. Interest rates keep going up because we get stronger than expected economic data. Now, there was really no data coming out in Monday's session of consequence, but we're going to get PPI, we're going to get CPI, retail sales. There's a lot on the calendar this week. Oil's going up too. That's inflationary. It's kind of going up more for those reasons right now. Even though there's all these geopolitical things going on, this appears to be, oh, we better send oil higher because inflation could be a problem. We still have a confirmed Hindenburg Omen with no additional confirmations, at least yet, but now that's as of Friday. The NASDAQ and NASDAQ 100 are still below their 50 period moving averages. This was an area that had been holding up a bit better. Well, it gave that up on Friday and it continues to give that up, at least in Monday's session. Our list is a little bit shorter. We've worked up a bit of this extreme negative reading, but we still have the Stochk RSI, the CCI 14 and 20, and the slope oscillator that are extreme negative. And we just have the Arun indicator in the intermediate term. And there's no change right now to the overall scenario with the Fed that they've increased their inflation outlook. They're probably done, or they are done cutting rates until proven otherwise. The dollar was up, even though it's been down a little bit, and after hours it did advance during the session. And we're starting to watch the 30-year yield again. It's getting close to that 5% level. Well, at 4.99, you can't get much closer than that without hitting 5%. And with the 10-year yield, it continues to go up. We're at 4.8%. Is the 10-year yield? Well, that hit 5%. So these are the things that we're watching, and we're seeing a pretty strong interplay between the stock and bond markets right now because of inflation fears and interest rates going up. Sentiment is negative, but we did tick up one notch since we ended up closing slightly positive. We had been at 26. We closed at 27. We're still above that 25 level where we start to get extreme. And we're negative with our trend. The ADX is still above its moving average. It's still above 20, so it's a strengthening negative trend. I changed our bias to mixed. I know it's usually either up or down, but you could say that we were positive on the day because of the way the market clawed its way back. You could say it's mixed because we're still looking more or less negative, but we did see a pretty good improvement throughout the day. But the momentum still, the last 2, 3, 4, 5 days together, it continues to be negative. Okay, didn't really have any economic reports. There was something, the Treasury budget or something, but it really doesn't have an impact on what happens here. So I have a few charts, and I do have some few additional Twitter charts that I thought might be useful. These are actual S&P 500 earnings growth, and it has exceeded expectations during the last few years. And this was as of last week. So if you look at this, we're coming up into the 2024 area right now. Later this week, we'll start earnings season. The banks are going to be reporting, and there's a lot that the market's going to digest. We'll see if the overall negative scenario shifts over into something more positive. If earnings come out looking good, if we get friendly numbers with PPI and CPI, that could shift things over and have it look more positive. All right, then the concentration of the market cap for the S&P and earnings in the 10 largest companies, and this is no surprise. Seems like every day I show a chart that has some variation of this, where the earnings and then the market cap shows how the 10 largest companies are really controlling the indexes, and that's why we watch these companies. Then Goldman Sachs Financial Conditions Index, this is going up a little bit. It's getting tighter. And so that's what's been pressuring. Now, one of the components of things getting tighter are rising interest rates, and that's why we're seeing some pressure right now on the markets. And then the rolling 12-month percent change, and you could look at this a couple of different ways that okay, we're getting kind of a high reading and then possibly coming down now. But you see the shaded area, there's no recessions in here, and we haven't hit that at least yet. So this still could have more room to go to the upside, but maybe we're getting a little overextended here. Now, this is quite long term in its approach. This goes all the way back to 1950. So we're, but we're still maintaining a positive trend as far as the long-term trend for right now. Okay, systematic strategies. Now, this is when you use a system, and they don't really give a definition of those systems, but you just follow this plan over and over, no matter what's going on with the stock market. It could be like dollar cost averaging, could be a systematic plan where maybe you put $100 a month into some kind of a retirement plan or a mutual fund or something like that, maybe into ETFs, and you do it no matter what's happening with the economy or with the stock market right now. And this just shows the those folks that are using systematic positioning here, and it's been increasing lately. Okay, and then the equity risk premium. I actually included what Bloomberg tries to interpret here. It suggests that investors might find U.S. Treasury bonds more appealing. Well, not yet, because we're still going up with interest rates. At some point, we may hit with the 30-year, with the 10-year, even shorter term maturities, a point where investors come in and say, okay, I like this interest rate. If I get into bonds right now, I'm going to go in and buy some bonds. And if a lot of people do that all at the same time, that's going to start pushing bond prices up and interest rates down. Okay, then a couple charts that I ran across here. This is looking at the job expectations according to this measurement, and I'm trying to figure out where it's from. Okay, then it's a Bloomberg chart here, but job separations expectations and the mean probability of losing a job or leaving a job voluntarily, and these are going down right now. And so that is showing more strength in the overall job market. Okay, then hedge funds, they're very bullish on the dollar. You might want to be a little concerned about that. Now, hedge funds are big money, but they're not necessarily the smart money. And when they start swinging everything all over in one direction or the other, sometimes we tend to look at this as a contrarian indicator. And then 40% of the revenue of S&P 500 companies come from abroad. That's why I say a lot of S&P companies do business, especially in China, Japan, and with other countries. And this shows that they're international companies. That's why we keep an eye on what's going on in China, what's going on in Japan, in Europe, and so forth. And market implied probability of a rate hike over the next year has risen sharply. So now they're actually talking about maybe the Fed's going to come in and push rates back up. You know, we've been in this environment where are they going to cut? Are they going to cut? Well, they're going to stop cutting for now. Now there's becoming more of a concern with these stronger than expected economic reports that they may have to come in and actually raise rates. And then keeping an eye on the 10-year yield in Japan, it's going up. And this was a catalyst for what happened last summer. Is that going to bleed over? Now, as I started to record this, which is about 10 hours before the market even opens, we're up with the futures about 0.3%, but it's many hours. Things can change. Europe hasn't even opened yet at the time I'm recording this, but Japanese rates, which had been so low for so long and were even negative there for a while, they continue to go up. And this may produce some kind of a catalyst similar to what we saw over the summer. We also want to keep an eye on China. Their rates keep going down because they're trying to do everything they can to stimulate the economy there, and it just really hasn't helped things all that much. And then professional investor positioning. We're seeing a drop off here. This is an interesting thing that I found on Twitter, X, whatever you want to call it. And now there's even talk of Elon Musk possibly buying TikTok. That could be interesting. Just rumors, just thoughts at this point. But it says this year's sharp decline in funding spread in funding spread should be the suggests that institutional investors positioning in equities is shifting. And this is according to Goldman Sachs. And we're looking at this spread funding here, which is actually going down, where they had been going more hand in hand with what's been happening. Now, this is smart money, and so we want to be aware of this. Okay, here is the intraday chart. Now, like I said, if you just go with the closing value, it's like, not all that big of a day. But we gapped lower and then set the low right at the open. And then we were able to come back up to S1. We chopped along here. And then the open finally got finished right around lunchtime on the East Coast. Then we started to see some buying in, not straight up, not all solid green bars here. There's some red along the way, but we just kind of chopped up and ended up closing positive and closed at the high for the session. So that's positive when you look at this intraday. And we're up a little bit here with the initial overnight session. We were down with the when we opened Sunday afternoon or evening, and then dropped off as Europe was under pressure, and then tried to make a bit of a comeback. We actually repaired things. We were down as much as 1% with the S&P. By the time we opened, we were down about 0.6%. And then we spent a lot of the day just after we set the low, chopping our way back. And so intraday, this is looking kind of positive here. We want to see if we get more follow through to the upside. That's why I show a historical version of this. Going back to January here, when we were really dropping off, and then we saw some positive action. These were on some up days. This is when it looked like the market was actually improving. Well, are we going to see more follow through to this? Because our charts aren't really bearing this out right now, but intraday we are seeing some improvements. We're still looking okay here with the blue line above the red line, and they both clawed their way back after showing some weakness earlier in the session. This is still holding up, but value had a better day than growth. But we're not really falling apart here, even though on a daily basis, value outperformed growth. Going back to the end of November, this still has been looking pretty solid. Then end of day, we were down with growth where value was up. We were down less for the mid caps, and small cap had growth down where value was up. So this was more of a value driven type of market in Monday's session. We needed to be more growth oriented to have things turn more positive. So we're coming down a little bit, but still positive with our small cap growth to value ratio, mid cap growth to value ratio, and S&P growth to value ratio. So it took a bit of a hit here, but we're still on a longer term uptrend. Coming down when we compare the growth versus value ETF, but it had been giving us very high readings. The discretionary to staples ratio continues to hold up fairly well. We're still below the 50 period moving average with large cap growth. That was lost last week, and that's kind of negative. We're going to need to be able to get this back to see things turn more positive again. And our trend is still negative. We're above the moving average and going up. The red line's going up and we're above 20. So intermediate term trend based on the ADX is negative. We continue to be negative here with the short term as well. Those are confirming each other. And we were above average with volume after it had dropped off there. And it got a little bit skewed on a weekly basis because the market was closed last Thursday. Sentiment, here's the weekly look here at 62.28. That's more neutral. Where you look at the gauges that we follow, we're close to the low end of this fear area right now, which I call negative. And the ulcer index ticked back up a little bit. There's still a lot of fear in the market according to this. And then once a week we get the insider buying ETF here. It really dropped off in the latest reading because we're seeing a lot, a real advance here with this particular insider transaction ratio that we follow as well. And I just show this once a week, mainly just for information. We are coming down as far as sentiment. I usually show this over the weekend, but it wasn't available then. So we're not as extreme with sentiment according to this gauge. And we ticked down a little bit on a closing basis with the VIX, but we're still getting a pretty high reading. However, we're below 20. Now we shot up above 20. We opened above 20. Then we were able to come down. So we saw some intraday downward movement with the VIX, which could be positive as well. But the VIX of the VIX still continues to be well above the moving average, even though it declined with the bar chart and the line chart. The momentum of the VIX continues to be up, so that hasn't changed. The MACD is suggesting that we're still going up, even though we closed pretty much at the low for the session since we closed at the high based on price. Still getting a high reading with the skew index. We're up in this red area, even though we're dropping down. Now, one thing I've been trying to point out is this coming Friday will be options expiration, and this is calculated, the skew index is calculated using options. So perhaps, this is just a guess on my part, that maybe this will come more into line as we approach and then go beyond this Friday's options expiration. And we're going up with this fear gauge. We went down with this other fear gauge. A bit of contradiction there. Seeing a bit of a hit here with our risk on to risk off ratio because value had a better day than growth. And we came down with the equity put call ratio on the daily chart, but we're still going up with the 5-day chart. Here's a longer term look at the 5-day chart, and we're still going up with the 10-day chart. That's more negative, but we're not really seeing any conviction right now. It's not really moving in one direction or the other. And still showing not much fear here with the volatility risk premium. Came up, but underneath the range. So it's still quite low. And ticked up a little bit after seeing some weakness here with the advanced decline line based on price and volume. So a little bit of an improvement there, but we're not seeing much of an improvement here. Even though the new highs are pretty much, well, they contracted from Friday. The new lows contracted from Friday, but they're still the red is outweighing the green here, and so that's why we're going down with the 5 day and the 10 day. This internal measure has not turned more positive, at least yet. We're still below zero with the advanced decline ratios, and those are negative even though they improved. Now, this is actually turning positive. We're crossing back above the moving average with accumulation distribution. This is a smart money indicator. I would ignore the boom indicator down here because they're way off. We're crossing back above the moving average here. So this is actually looking more positive, but we've been flatlining quite a bit. I mean, Tuesday we could drop that down below this if we don't have a lot of follow through buying. And we're also improving here. After Friday, we saw the Chaikin money flow going back up. We're going back up again after Monday. The red line is going up. This is actually considered positive right now. And the Chaikin oscillator is also going up. So our three smart money indicators have switched over positive. We're just not seeing it yet coming through with the other charts. And this is a little bit positive here. We're negative overall with the vortex, with the red line above the green line, but the red line's coming down. Now, in Friday's session, we saw the green line actually go up a little bit, but it didn't go up in Monday's session. And so not seeing much of a change here with the cumulative advanced decline line for the S&P based on price or volume. It ticked up just a little bit there. A little bit of a tick up here with our advanced minus decliners on a 10-day average for the S&P. Still going down here when we look at the 10-day average of highs and lows for the S&P. So these more internal measures are not improving. They're still getting worse for right now. And we so far have been able to bounce up off of the 200-day moving average with the NYSE advanced decline line. A little bit of an improvement with those stocks in the S&P above their 20-period moving averages, as well as the 50-period moving average study, but still extreme. Coming up a little bit with the 100 and also coming up a little more off of 50. We had almost got down to 50. We were at 50.8. Now we're at 54. So these internal measures are showing some improvement. And coming back up to the moving average here, with the advanced decline line for the NYSE based on the accumulation basis. And we're still not really looking all that strong here with our regular NYSE advanced decline line, and we're actually going down a little bit with our other NYSE advanced decline line. You break it out based on common stock, really not much of a change here. So we're not seeing this, but it's not falling apart either. As negative as we were, this repaired a lot of damage as the day was done. But this is not really improving. The advanced decline line study is still below the moving average with all the indexes that we follow, with the moving averages going down. But we did tick up with the different indexes. So we're still below the 50-day moving average. We came down to this pivot, and so far that's holding. And there's some other charts where I'll point this out. This is a support level. This is pretty good that this held, at least for right now, and we were above average with volume. And then just looking at the chart itself, and I showed this for Monday's video. I've been trying to point this out when without lines, without indicators, where we set our high back in December, and then we came back and set a lower high, and then we came back and barely set a lower low here, and then set another lower high, and then set another lower low after Friday. Well, intraday, we set another lower low. So this is still looking vulnerable here. Lower highs, lower lows. But the fact that we closed at the high for the session and we're holding on to other support could be positive. So there's a positive takeaway from this in that we closed at the high. There's a negative takeaway in that this overall structure is not looking all that positive. And bouncing back up with our 20, 50, and 200-day moving averages, we're still extreme negative with the Stochk RSI, no longer extreme with the Williams percent R. The CCI 14 is still extreme, as is the CCI 20. And we're not extreme now with stochastics. We bounced up enough in the short term. We're still going down in the intermediate short term, and the long short term stochastic continues to be negative. And these are just further subdivisions of the short term time frame. A little bit of a bounce, but still negative with the force index. Still looking more vulnerable with our short-term trend based on 20 periods. We're below the lines and the lines continue to decline. We're below the 20 period simple and exponential moving averages. And still below the midpoint, we're in the -2 channel with our standard deviations chart. This is encouraging though. The balance of power is actually turning back positive. Still negative with the go, no go, with the dark purple here, deep purple, and coming up a little bit, but still negative with our highest high, lowest low value chart, and still looking negative with the TTM squeeze here, where we're having the darker red and it's continuing to decline. So not much of an improvement there. A little bit of a tick up, but negative with the ease of movement. We're still extreme negative with the Arun. A little bit of an improvement, but still negative with the S&P McClellan oscillator. So we continue to go down with the summation index based on price and volume. A tick up with the NYSE McClellan oscillator, but still below zero. So we're also continuing to decline with the summation index for the NYSE based on price and a little bit lower tick here based on volume. And not improving here. The Swenlin trading oscillator didn't really pick up any positive action from Monday's improvement here. So we're still declining based on price and volume here with the Swenlin trading oscillator. Momentum is still down. The PMO is going down, but we're seeing a bit of an improvement based on price and volume as well. And a little bit of an improvement with the PMOs that are rising. We're still going up with the buy signals. These are some internal things happening. We're flattening out, but still slightly declining with those PMOs above zero. Still declining with the Sean trend meter. And going back down still below this red line with the slope oscillator, short term, the MACD continues to decline. We're still declining in the short, intermediate, and long term with all of our momentum oscillators, and the Copic curve is not crossed back above its moving average. Trying to improve, but isn't quite there yet. Coming up a little bit, but still below 50, so it's negative with the money flow. Also coming up, but below 50 with the ultimate oscillator. Still above the moving average, though, longer term with unbalanced volume. Still below 50 with the RSI 14 and the RSI 9. We're watching this. This is the mass index. We've crossed above the red dashed line. We're getting close to the blue line. If we roll over and cross back down below the red dashed line, that would suggest a reversal. And the Pring bottom fisher, this is 2 days now where we're getting a buy signal from this. And sometimes this can be a pretty worthy signal. Other times it's just, what? It's telling us to buy when obviously that's not what should be happening. We are still negative with the Elder's Impulse system for the S&P. We're still negative with the parabolic SAR. We're still negative with the intermediate term trend based on 50 periods. The blue line and the red line continue to decline. We're still below the simple and exponential moving averages based on 50 periods. This is encouraging though. We actually came down. This is the S1 level that I wanted to point out. This was the low and we bounced up off of that. And by the time we closed, we recaptured the 100 period moving averages. That could be encouraging. Now we need to see more follow through from this. And we're not getting pretty much any other confirmation unless you're really, really convicted and you're really willing to take some risk. You'll look like a genius if you're right, but there's not a lot of follow through confirmation yet for with what we're seeing. But so far, this is positive. So we're still below the 20s and the 50s, and the 20s are starting to come down into the 50s here on this moving average tree chart here, but we're still above the 100. We decline with the bullish percent index. That's more negative. We're continuing to go down here. We're declining with the NYSE bullish percent index and the Nasdaq 100 bullish percent index. So we didn't see any strength there. And we're still below the cloud with our Ichimoku cloud. And the blue line's still below the red line, and the green line ticked up just a little bit because we had a positive close. We're still looking at this longer term trend channel where we came up in early December, and that pretty much was in a level that the market was not able to get through. And we've been coming down ever since then. And we're still negative on a trending basis with the hike in Ashi still looking negative. The Kegi chart is red and pointing down, which is negative. The Renko has a red block. That's negative, and we're still negative with the three line break. And we had enough of a lower open with the point and figure chart to draw in another O here. And so this is not positive right now. This could be a triple bottom breakdown. Yeah, sounds like a dance. Where we came up here three times with X's and now we're starting to go down. So this chart formation is actually more negative. Long term, saw a little bit of an improvement with the 150 and 200 period moving averages. We're still negative in the short term with all of our stock indexes. We continue to be negative with the mid caps and the small caps. And seeing a little bit longer, we had been looking better here with commodities. And this is more inflationary, and these going up is causing some concern. We're negative in the long term, but positive in the short and intermediate term. The dollar is still strong. Bonds are still negative based on price because they were down again. And we only had two sectors ended up being down. Unfortunately, one of them was tech, and that's a growth area. Communication was up, but not very much. Discretionary did a little bit better, and it outperformed staples. That's why the discretionary to staples ratio actually showed some improvement. But not seeing anything really strong here. It was more of a value driven day rather than a growth day. So we started off with an awful lot of red. We got below 5,800 with the S&P, and then the Nasdaq was below 19, then it got back up to 19.1. The euro just keeps going down, the dollar keeps going up. We broke below 19,000 with the Nasdaq. We had a BPI cross below 50 with tech. That's not really good. And below 42,000 with the Dow, and then didn't close there, but the dollar got up to 110, which again, that's if you want to go traveling, that might be useful. Saw a little bit of a tick up here with the equal weight as well as the weighted version of the S&P, but they're still, when they're far apart like this, it means the large caps are still holding up better. And came down a little bit more with our ratio as the S&P, at least in Monday's session, underperformed the equal weight version. But if you go back to this chart, we've got a long way to get back to have them more matched up with each other. And the Dow, it was a stronger area. Um, I forget the United Healthcare, I think, had some positive news that came out, and that they pretty much, and they're huge, and they pretty much held the Dow to looking positive here, but no real changes from a technical standpoint. We've gone from negative to neutral with the diamonds, with the Elder's Impulse system. The Nasdaq continues to be below its 50-day moving average. It did end up closing at its high for the day and above this S1 level. That might be important. We came down to this S1 level with the Nasdaq 100 and also closed at the high. That's positive, but we're still below the 50-day moving average. And we're still negative with the Elder's Impulse system for the Qs. The momentum for the Nasdaq 100 continues to be negative. We're still below the 50-day moving average for the Qs, and we're seeing this 20-period moving average rolling over a little bit now. And this is encouraging too. I pointed this out over the weekend. The S&P 600 small caps tested their 200-day moving average on Friday and closed up off of that. We fell below it on Monday and closed up off of that as well. That's encouraging. Now, one thing I did point out over the weekend is we weren't at the 200-day moving average with the Russell 2000 small cap index. Well, we came down, hit it, and bounced up off of it, and small caps closed near the high for the session. That could be encouraging. We may be getting some support from small caps. But we're not seeing things switch over and looking positive yet. Coming back up a little bit with the RSI, we're still looking negative here with the momentum for the small caps. Still negative with the Elder's Impulse system. And closed at the high here for the mid caps as well, but no real improvement, just coming back up into the range where they've been. So, but they have switched from being negative back over to neutral with the Elder's Impulse system. Still below the 50-day moving average with the Wilshire, even though it ended up closing positive, still below the 50-day moving average here with the total US stock ETF. So looking at the financial sector, we were up, but we're still below the 50-day moving average. Now, as I said, banks are going to report later in the week, and these are very influential companies. If they come in with good, solid earnings reports, that could help the financial sector. And there may be what we're watching for now is we were up 0.72%. is it buy the rumor, sell the news kind of a thing? It could look like things are turning more positive for the financial sector, but then when the banks come out with their earnings, there could be selling, even if it's a really good earnings report. So be aware of that. The FANG index is still holding above its 50-day moving average, even though it's down 0.78%. We're holding above this longer term trend line. We broke down below it, but we were able to close right a little bit above it. This is holding up for the time being. Apple was down over 1% below their 50-day moving average. Amazon still above its 50-day moving average. Microsoft dropping below its 200-day moving average. Google still looking pretty solid here, but it was down over 0.5%. Meta was down over 1%, but still above its 50-day moving average. Nvidia kind of in between. It's under its 50-day moving average, but still above its 200-day moving average, down almost 2%. Tesla was up 2%, still above its 50-day moving average. And Netflix up 1/3%, but still below its 50-day moving average. So there's more work that needs to be done to turn more positive. Seeing a real improvement here with the short-term correlation between US and world stocks and a more gradual improvement here with the correlation longer term. And semiconductors, it's just been hammering on those, down over 1%, but still above their 200-day moving average with the SMH ETF. And as we topped out here, we hit three tops, and then we've been coming back down over 1% again with this. And we're down below the 50-day moving average with the Dow Jones Semiconductor Index. And this has already been negative. The SOX index dropping further below the 50-day moving average and in a downtrend. But it did close up off of the low, so that's encouraging and not really seeing much of a change here with the semi to tech ratio. Oil starting to go back up now. That could be causing some inflation concerns, or are inflation concerns causing oil to go up? It's kind of one of those chicken and egg type of things here. And the dollar continues to be strong. It did get up into the 110 range. Now, this is when I took the chart. We've actually fallen back a little bit, but we were up on the day. And we're keeping an eye on bonds. They're really what's driving the stock market right now. We continue to go up with the 10-year yield. We continue to go down with the 10-year based on price. Seeing a death cross here with the 7 to 10-year Treasury bond ETF. Looking at the total bond ETF, still falling further below its 200-day moving average. And want to keep an eye on the 30-year yield, getting up ever so close to that 5% level. But we closed at 4.95% after Monday. And also because interest rates are really driving things right now, we're watching all of these different maturities continue to go up here. And this is causing not any real improvement when we look at home construction to 3 to 7 year bonds. We're still well below this 250 period moving average that had held before. And looking at this, I talked about this over the weekend. The TIPS, Treasury Inflation Protected Securities, which can adjust for inflation. That's what folks get into when they're worried about inflation and they're worried about interest rates going up. And we're seeing them really outperforming now these 7 to 10-year bonds. So, and they're in an uptrend. So this is showing that the market is concerned about inflation and interest rates. And came down a little bit below the moving average with our growth to value ratios when we look at the Qs to S&P, coming back up with discretionary to S&P, dropping a little bit below the moving average when we compare large cap growth to large cap value. So the large caps are a little bit under the moving average, down to the moving average with the mid caps, and a little bit above the moving average with the small caps. So no real changes there. So what's our outlook? And as I said, earnings season will start and it's going to be kicked off mostly. There's Alcoa, I believe, that reports at some point this week. They're like the official start of earnings season, but it's really when the banks report later this week and then coming up into the week after, most likely. We're still somewhat oversold in the short term, and intermediate term, we're just negative. So we haven't seen a real shift, even though we have seen some improvement, like the smart money indicators, like holding support in certain areas. But now we need to see where do we go from here? Can what we've been building off of in Monday's session continue to follow through into Tuesday's session? And we're going to get the NFIB Small Business Optimism Index and PPI will be coming out. And then all the geopolitical things, all kinds of stuff going on. Plus, less than a week from now, there will be the inauguration of a new president. And there's everything, all the hoopla that goes on with that. And what kind of executive orders are going to be signed? Are they worried about it now? And then once those orders are signed and once new legislation tries to start get into process that's already been developing, is the market going to like that? Or are they going to treat it as something negative? Okay, and then we do have PPI on Tuesday, CPI on Wednesday, retail sales and jobless claims on Thursday. So it's a pretty big week. And then we will get some kind of influential information on Friday. Housing starts, building permits, industrial production, and capacity utilization as well. And so here is the forecast and what the previous reading was for PPI on Tuesday. Seasonality, no real edge one way or the other. Neutral to positive with the Dow, neutral to negative with the NASDAQ. And kind of flat here when you look at the post-election year for the S&P, the green dashed line. No real edge that way. And we're starting to get into the second half of January, which tends to perform a little bit better, where the first half really hasn't lived up to it. It's usually one of the better performing times of the year, but just hasn't happened this year. Small caps should be going up. Not really, not now. At least seasonally they do. And then coming up now, we're still in the latter part of this positive seasonality here, according to Tom Bowley's research. So the advanced decline line still ticked up, but still not looking all that good. We're still going up with the 5 and 10-day equity put call ratios. The summation indexes and McClellan oscillators for the NYSE and S&P are negative, and our bullish percent indexes are negative. Parabolic SAR, the Swenlin trading oscillator, momentum is negative. The confirmed Hindenburg-Ullman with no additional confirmations, at least yet. The vortex is negative. Our moving average studies are negative. Ease of movement, money flow, and the ultimate oscillator all improved, but are still negative. And our momentum for the NASDAQ 100 is still negative. But the smart money indicators, look at it. We're over on the positive side now. We could lose that. But based on the intraday price action that we saw, these pick that up and are showing an improvement and have actually turned over positive. Growth to value took a bit of a hit on Monday, but still looking pretty good. Discretionary to staples actually improved, and we're still above 50 with our 200 period moving average study for the S&P and the financial sector, with the banks getting ready to report. And then here's an update of the Hindenburg-Ullman chart. No additional spikes, at least yet. So our conclusion, we're still negative. Large caps and growth, they're holding up. Now they've been losing some support at their 50-day moving averages with the large caps, but growth took a bit of a hit, but still holding up for the most part. We did see positive intraday price movement and the support with the small caps at the 200-day moving average, the 100 period moving average for the S&P, and some other ones that I can't remember. But this support is holding for right now. We are still negative in the short term, and we're less oversold than we were before. Intermediate term, we're negative. We're below the 50-day moving average with the 100-day moving averages holding. We are still positive in the long term. Thank you. I hope you have a really good day, and I will talk to you in the next video.